Mike. I'm the Chief Investment Officer here at Lighthouse Financial, and I'm with you for another edition of Mike's Market Update. Let's get started. Okay, so May 25th, 2023. My last video was very early this month. I think a lot has transpired since then, so I'd like to get you up to date. So here are talking points for today. Pretty simple. The first one is the Fed is winning. They really are. Inflation is definitely slowing. The economy is also slowing as a byproduct, but I don't think the situation is dire there. We still don't see recession right around the corner. And I think it's time for the Fed to go easy in terms of more rate hikes and monetary tightening. I also want to talk about the job market. It's been pretty resilient, and that's a two-sided coin. On the one hand, what a blessing, and that's probably what's keeping us out of recession. On the other hand, we do have a structural shortage of workers here in this country, and so it's not all positive. We need to rebalance the labor market. And finally, we got to address it. It's the elephant in the room, the debt ceiling crisis or fight between the president and Congress. My point here is we've seen this before many times and survived. So let's get into the details. Okay, the Fed is winning. This is a picture of inflation. The blue is wholesale inflation, inflation for companies producing goods or services. And then the black is consumer facing or retail price inflation. And you can see, boy, that PPI number, that wholesale inflation in the blue has really collapsed. And we are nearly back to what I would call normal. Some say that the PPI or wholesale inflation leads consumer inflation. I hope that's the case. We have seen moderation clearly in the CPI, that black line, but it's still, we're still not back to normal. And you can see pre-COVID in the left-hand side of this chart. So we need to get back there toward 2%. I think that's going to happen, but it's going to take some real time. And let's hope that the Fed realizes it's been pretty successful here and starts to go easy again with the rate hikes. Now, this chart shows the interest rate that you can get by investing in different maturity treasury notes or bills. And it's pretty clear looking at it that the highest rate you can get is the lowest maturity, 1 month. And Josh Brown, who's the CEO of Ritholtz Wealth Management, interprets this chart like this. Nobody believes we're still going to be fighting inflation this time next year. At least nobody who's actually betting with real money. Okay, so it's pretty clear that the smart money believes that inflation is going to continue falling. You can see those interest rates as you go further out in maturities from 1 month to 4 month, 1 year, 2 year, 3 year, 4 year. Those rates are getting lower and lower. And so, it does seem like we might be experiencing a Fed pause. In other words, the Fed might recognize it's winning and start to go easy. This is a quote from Andrew Tyler, an analyst over at JP Morgan Chase. It does feel like the market is watching a race between inflation and the Fed, meaning can inflation fall fast enough for the Fed to move down from restrictive territory before we see something bigger or worse than March's banking crisis. Just a little aside about that mini banking crisis or liquidity crisis, whatever you want to call it, in mid-May or March, rather, that really put the US banking system on alert. And it is very clear that banks are restricting lending. They're tightening lending standards and just sort of pulling back. And that's going to slow the economy all by itself. Now, whether the Fed, calculated that this was going to happen as a byproduct of it, raising interest rates so much so quickly, I don't know. But it's a reality on the ground, and this, again, is a two-sided coin. The good news is it is going to probably go a long way toward convincing the Fed it needs to tread lightly. Okay, on the other side of that coin, it's clear that, whenever you constrict the flow of credit in this economy, credit's important. So when you constrict that flow, you're going to see slower growth. And this chart kind of shows that a little bit. This chart shows two lines. The orange line is a survey of business activity within the non-manufacturing or the services sector. And then the blue line is the same thing for the manufacturing sector. You can see that manufacturing's been hit pretty hard since mid 2021, and any number below 50 in this survey means contraction. In other words, a manufacturing sector in the U.S. is going through its own mini sort of recession at the moment. And while services is slowing, that's the orange line, it's not slowing near as much, still above 50, a little bit of recovery recently. And I'll say that services is a lot more important than manufacturing, just because that's a bigger piece of our economy. It's clear that they're slowing, but we're not close to where we were in COVID when everything shut down either. Let's take a look at some commentary from CEOs to try to get a look at what's going right and wrong in the economy. And so we'll start with wrong. These are sort of negative comments from some key companies. The first is J.B. Hunt. They're a trucking company, and they've called out a freight recession. Like right now, they're going through a freight recession. In other words, business is contracting. They're seeing their own pricing is having to fall, but wage costs are still rising. And of course, we know that there are no more boats waiting to be offloaded outside the Long Beach and LA harbors. Right? That was a COVID thing. This is the other side of that. We were dealing at that time with soaring freight costs because there just wasn't enough capacity to deal with all the goods, not enough truck drivers. Now we're seeing the opposite side of that. Qualcomm is a semiconductor company, and they have big exposure in China. And their comment is this: we now expect global handset units or cell phones in calendar 23 to be down at least a high single-digit percentage relative to calendar 22, which is lower than our prior expectation. It is pretty clear that although Apple's iPhones are doing pretty well in the US, we know that China is having a tough time restarting its economy, and it looks like Qualcomm and a bunch of other semiconductor-related companies have suffered because of that. Next is Fastenal, and they make construction supplies, screws and hinges and so forth. When you look at the trend in industrial production, we needed to be looking forward and really have a plan to be cautious about hiring. Okay, we know that commercial construction is slowing. There's no doubt about that. And home improvement to some extent is also slowing a bit. We saw that out of Home Depot recently. So that's an area in the economy that it's kind of a little bit of a sore spot right now. And finally, and we all know this, REITs or real estate investment trusts. So especially within the office segment of that group. And the comment here is the combination of rising interest rates and the recent banking sector challenges has impacted debt availability across the commercial real estate industry, and particularly in office. Again, I keep going back to this, but they're just involved in this hangover from COVID, when a lot of companies sent their workforces home, and now many companies have hybrid work environments rather than 5 days in the office. It's 4+1 at home or 3+2 at home, and so the demand for office space is really plummeted, especially in key areas like San Francisco, New York City. So they're calling out just weakness here, and it's partly that COVID hangover. It's also partly restriction in credit. So interest rates are higher. If your business is reliant on a lot of debt, and that debt just got a lot more expensive, your profit margin's falling. So this is another area negative. I want to then highlight some of the positives, and they're not a surprise to you either. So Visa, credit card company. They called out healthy U.S. global growth, but they noticed April slowed down a little bit. They thought that was mostly due to falling inflation, like gasoline prices, and they say lower tax fund refunds as well. Nothing alarming at all. And they said, look, it seems like consumers still have plenty checkable deposits. We learned that from the banks as well. The dollars on deposit for the average U.S. consumer far higher than pre-COVID. And I guess that's why Delta is saying, look, we may see pulling back in other areas, but not in travel. And this is the CEO saying, I don't see it in our credit card data. I don't see it in our bookings. And if you've tried to book a vacation for this summer, airfare is still pretty high. This is Royal Caribbean. This industry, the cruise industry, really took it on the chin in COVID and after. And they say the fact that demand for the coming 9 months is so much stronger than our already robust expectations says a lot about the strength of the consumer and the strength of our brands. It doesn't say anything about the strength of their brands. It says everything about the strength of the U.S. consumer. GM. Everybody sees price declines around the corner, but that corner just keeps getting further and further out. I want to say a couple of things about this. What this executive is talking about is that there are a lot of predictions from a lot of industry watchers, experts, and economists that everything's going to fall apart, and we're just not seeing it. As he said, as that corner just keeps getting further and further out. We also heard from the CEO of Porsche that demand is very strong. Thank you very much. So again, from our standpoint, it is just not a foregone conclusion that this economy dumps into a serious recession. I think it's much more likely, given the comments that I've just read to you, that what we're dealing with is a series of rolling recessions through individual sectors at different times. And that's just, all of this is a byproduct, again, of the COVID hangover. We still have not financially gotten over COVID. Maybe the health crisis really is past. Maybe socially we've turned the corner, but financially not yet as an economy. Okay, I gotta talk about the job market, because that's the key area that's keeping us afloat. As I said, I think that's one of the main reasons that we are not in an economic recession now. And it is true that the job market is slowing. Okay, and the top chart is the number of unfilled job openings and or job positions in the U.S. And you can see that last March, this number peaked out at 12 million, which is considered very, very high, and has fallen off since then to about 9.6 million. That's still high, but we're on the way down. It's really hard to predict a recession when you have this many unfilled jobs. On the bottom chart there, it shows a number of layoffs and discharges. And so you can see that starting to tick up, right? Since, well, for about the last year, that number has slowly made its way higher. If I were to zoom out, to 10, 15, 20 years and show you this chart, it's a tiny hook at the end of a very long downtrend. So a little bit of slowing in the job market, but nothing, again, nothing alarming at all. And the fact is that we just have a labor shortage. This chart shows that if the labor force participation rate, in other words, the portion of working age people that are actually employed, if that was the same as pre-COVID, we'd got 2.9 million more workers now, and there wouldn't be a shortage. I think we gotta figure what 1.1 million Americans died during the COVID pandemic. In addition, a number of kind of older working age people retired early in their 50s and early 60s and just hung it up and said, forget it. Other people had to quit and stay home, or were part-time because they had to deal with childcare during the pandemic, or some were just fearful of exposure. I know we're dealing with a shortage of nurses in this country, partially because that's a lot to ask, that kind of exposure on a daily basis, and so that's kind of the reason why we have this labor shortage. One of the reasons that the Fed is raising interest rates is to try to bring that back into balance. Because you think about it, if you have a structural shortage in labor that goes on for any length of time, you're going to have rising wages because employers have to compete for the qualified good employees, right? So that contributes to inflation, which the Fed is trying to bring down. So here's that wage growth, and you can see that right after COVID hit, you see this spike in average hourly earnings, and then it dips off, and now we're still trying to find equilibrium. This chart is crazy. The chart makes no sense. These numbers are far out of whack. When I tell you that normally wage growth is somewhere from 2 to 3%, we got up to 8, and as low as almost 0. That just shows you how crazy things got in COVID and in the immediate aftermath. But the important thing is at the end of that chart, at the right-hand side, it's coming down. Now it's not coming down as fast as the Federal Reserve wants. Again, it kind of feels like a race between Fed raising interest rates and inflation slowing down. The faster inflation slows down, the more we can expect the Fed to go easy. We can see that wage growth is slowing, but we're not back to normal yet. After all corporations or publicly traded corporations announced earnings for their first quarter, BCA Research, it's a private research firm, made this comment after going through all those reports. We didn't hear anything that inspired us to bring our recession ETA forward from the first half of next year. The big banks are on alert, but the expansion still has legs from what they can glean from their consumer and business customers' actions. I like this comment because this company, their baseline expectation is for a recession, but it's for the first half of next year, and there's no reason to think that that's going to happen any sooner. These guys are fairly bearish, right? But they're saying that the expansion still has legs. I mean, even if you're talking to the banks about what their customers are doing, it's not terrible. So that's where we are. Everything is slowing, but it doesn't seem to be dire. And now I have to address the debt ceiling fight. And in many ways, investment advisors and economists don't want to focus on this because it's such a short-term event. And in the past, these similar types of events have not had a long-lasting impact on capital markets like the bond market, stock market, commodities. It's just been sort of a blip on the screen, and I'll show you why. This first chart shows all the times since the late 70s where when the debt ceiling was raised. The debt ceiling is simply a law that Congress passed to sort of try and limit the amount of outstanding Treasury debt. That's very difficult to deal with when you're engaged in deficit spending like we are. So what you see is a step up, a regular step up in the debt ceiling. That's the black line, and it doesn't matter over time who's in office, Republicans, Democrats. It doesn't matter who's in charge or control of the House of Representatives or the Senate. They raise the debt ceiling because, again, when the government is engaged in sustained deficit spending, you have no choice, right? So we've been here before. You can see a lot of different steps in this staircase. The last one at the very right seems to be, that's a pretty big step up, and that's because of COVID and all the government stimulus, extra debt needed to finance that stimulus. And so now you see why there's a little extra hesitancy in Congress to accept raising of the debt ceiling. But I believe both sides know what the stakes here are, and the stakes are very, very high. Let's talk about prior occasions when this was an issue. On the left-hand side of this slide, I've just written some of the years that we dealt with this, where it did impact the market on a very short-term basis, and all the way back to 2010. And I've just called out 3 of the more serious ones that I want to explain. 2011 and 2013 and 2021. And you may not even remember these, but I guarantee you in 2011, you were focused on it. At that time, we had slowing economic growth. We had problems around the world, European debt crisis. So there were other problems that were impacting markets. And then this sort of came along. Moody's is an independent debt rating agency, and they downgraded the credit quality of US Treasury debt from AAA. First time it ever been downgraded from AAA, because they felt like there was some kind of risk of the US defaulting. A deal was reached between the president and Congress 2 days before the debt limit was scheduled to hit, and that debt increase was $1.9 trillion. It also came with 10 years of some kind of spending caps, and they weren't draconian, but it was a deal. It was a negotiated deal. October 2013, you probably remember this if you think hard, 16-day government shutdown, right? So that's when the government just doesn't have the funds to operate all of its agencies at 100%. So, you had national parks may shut down at that time. Certain government agencies are temporarily shut, or skeleton crews are manning them. And the debt limit was temporarily waived just 1 day before the expected default. And that was a $500 billion debt ceiling increase. In the winter of 2021, it was kind of a longer period. It was 3 months of this political brinksmanship or theater, however you want to phrase it, and a temporary fix pending a deal that just came with 1 day to spare before, again, the expected default. So, and that's a $3 trillion debt increase. The point is, we've been here before, we've seen this. It's highly unlikely that the government allows a default, because, as I said before, the stakes are very, very high. It is not an exaggeration, okay, to say that the global financial system really rests on US Treasury debt. And I know that sounds really overarching, broad brushstroke and just kind of fanciful, but there's some truth in that. If our government defaults on debt, think what a precedent that sets. Think what that will influence investors all around the world to do in the future. You think it's tough financing government debt now, the high debt that we have? Wait till nobody's going to buy our bonds unless the rate is significantly higher. In other words, the cost of financing U.S. debt would go way up. So if the president and the Congress cannot reach a deal, they will be shooting themselves in the foot. Okay, so contingency planning. In 2011, some plans were created. They never had to be implemented, of course, but let's just talk about a few things that are kind of floating around in the media. You may be reading about them. No default in Treasury debt is necessary. We don't have to do that. We could just sort of, if no deal is reached, they could find other ways to cut. And so they could continue to pay interest on bonds, and just as bonds mature, they could just issue new ones to try to keep under that debt ceiling limit. They could delay payments for some government obligations, like defense contractors and so forth, until they have enough cash to pay like 1 full day. They could require federal workers to continue to work, but they just delay their paychecks until a deal is reached. It's likely that Treasury debt obligations and Social Security payments would be prioritized and wouldn't be limited or restricted or delayed. And then there's this final idea that's floating around. Does the 14th Amendment to the Constitution make this debt limit law simply unconstitutional? 14th Amendment has some language that essentially says, debt of the United States shall not be in question, meaning we're not even going to talk about, defaulting on that. So it is possible that the administration and the Treasury could say, yeah, our duty, our sworn duty, is to uphold the Constitution, and Constitution requires us to meet these obligations. Therefore, we will just continue mission and ignore the debt ceiling law. That is a possibility. So, we'll see what they decide to do. Our feeling is that, political theater is at its highest and most exciting when when you've got the deadline coming up right in your face. So don't expect a whole lot to happen today or tomorrow or next week. It's going to be right up against the deadline. And when is that deadline? Janet Yellen has said June 1st. I've also heard, well, that's there's some cushion built in there. Maybe it's the 6th or the 8th or something like that. But it could very well come down to the wire if history is any indicator of this event. I want to thank you again for watching, and I hope this helps you as you interpret the news. We'll be back in a month or so with another update for you. Thank you very much.